Welcome to the Knakal News Network. The Knakal News Network is brought to you by Massey Knakal Realty Services, New York's #1 building sales firm.
Hi, I'm John Hageman, Sales Team Manager for Massey Knakal. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of Massey Knakal, and today we're here to talk about distressed assets. Tell us what's going on in the distressed asset market.
There still is some activity, but I think to really put it in perspective, let's go back to where we were in 2009 and what we were faced with. If we look at the bubble inflating years of 2005, 2006, and 2007, there was about $109 billion of investment sales activity in the city. And based on the refinancings that took place during that time, we think that in total, there were about 15,000 properties in the city that had negative equity. We estimated that there was about $165 billion of debt on those buildings. The right amount of leverage on those assets should have been about $65 billion. Clearly that was not all going to come out because there were some properties that you would be able to hang on to. Other properties, owners had the ability to feed from income from other buildings. But we had estimated back in December of 2009, I think I wrote an article saying we expected 30 to 40 billion of deleveraging to actually occur. And our estimates today are that about $30 billion of excess leverage was taken out of the market in the form of losses and additional capital, additional equity that was put into properties.
Many people in the industry were predicting a massive refinancing problem based on the hundreds of billions of dollars that might be required to come out of the market. What's happened with that?
Many people in the industry were saying that based on all of the loan maturities that were occurring in 2012, 2013, 14, 15, 16, that there was going to be a tremendous problem and that wouldn't be capital available to meet the refinancing needs that the market had. What has happened is that the low interest rate environment that we've had has helped tremendously. And I think it's just a byproduct of the government trying to help the housing market. Our commercial real estate industry has been a beneficiary of that. And the low interest rates have really helped to exert upward pressure on values. Those increasing values have helped to re-equitize properties that were in negative equity positions. And today, based upon how profitable the lending business has been, there are a lot of banks that are back in the market, and with increasing values and low rates, many of those properties that people anticipated would have difficulty being refinanced have been able to be refinanced. Well, Hags, that's something the marketplace was talking about for a while, that those loans that were made at very high loan-to-value ratios back in 06 and 07 would not be able to be refinanced in 2016 and 2017. To the extent that the market continues on the pace it's currently on, there should be no problem whatsoever refinancing those loans when they mature. But the concern is, will we face another downturn before we get to 16 and 17?
So what exactly are you seeing in the distressed asset world today?
Well, most of the distressed asset transactions that are occurring are of pools of subperforming or underperforming loans. There are very few foreclosures. There are some here and there, but it's not nearly the level that we saw in 2010, 2011. But today we just see distressed assets dripping into the market in a very, very slow pace, as is normal under any market conditions. So we think for the most part we're through this wave of distressed assets, and we'll see what happens in the next wave based upon when our next recessionary cycle is. In summary, it appears that we are well through the distressed asset cycle. The lower end of the $30 to $40 billion of projected losses has occurred, with our estimates being that about $30 billion of deleveraging has occurred. Today, distressed assets continue to be present in the market, but are mainly in the form of underperforming and subperforming loans.
Thank you for joining us today. Tune in next week for another installment on the Knakal News Network.